U.S.-Japan auto trade tensions, a brewing economic conflict. The relationship between the United States and Japan, two economic powerhouses with a long history of trade cooperation, is facing a significant strain due to recent developments in the automotive industry. At the heart of this tension is the U.S. decision to impose a hefty 25% tariff on automobile parts imported from Japan, with a particular focus on components used in the rapidly growing electric vehicle sector. This policy, enacted as part of a broader protectionist agenda, has sent shockwaves through the market, directly impacting the cost of vehicles produced by Japan's automotive giants, Toyota, Honda, and Nissan. These brands, once celebrated for their reliability and affordability in the U.S., are now seeing their prices climb, eroding the competitive advantage they've long enjoyed. For American consumers, this translates into a tangible hit to their wallets as the cost of these popular models rises in response to the tariffs. The tariffs' ripple effects are profound. Japanese automakers have historically relied on the U.S. market as a cornerstone of their global strategy, with millions of vehicles sold annually to American drivers. However, the increased cost of imported parts, many of which are essential to both traditional and electric vehicles, has forced these companies to pass some of those expenses on to buyers. This shift not only threatens their market share, but also challenges the perception of Japanese cars as a budget-friendly option. Meanwhile, the focus on EV components signals a deeper intent by the U.S. to reshape the landscape of green technology, an area where Japan has been a formidable player. By targeting this sector, the U.S. appears to be aiming to bolster its domestic EV industry, even if it comes at the expense of its allies' economic interests. Japan, however, is not sitting idly by as these tariffs disrupt its automotive exports. In a bold countermeasure, the Japanese government has begun offloading a substantial portion of its U.S. Treasury bonds, with $30 billion sold in February 2025 alone. As the second largest foreign holder of U.S. debt, with over $1.01 trillion in bonds, Japan wields significant financial influence. This move has weakened the U.S. dollar and driven up interest rates, placing immediate pressure on the American economy. It's a high-stakes strategy, one that leverages Japan's creditor status to send a clear message: it will not absorb the tariff burden without a fight. Beyond financial retaliation, Japan is also restructuring its manufacturing footprint. Rather than doubling down on U.S.-based production, Japanese automakers are shifting significant operations to Mexico and Southeast Asia. These regions offer lower labor costs and, crucially, allow Japan to sidestep U.S. tariffs by exporting finished vehicles from outside the tariff zone. Toyota and Honda, for instance, are pouring resources into new plants in these areas, ensuring they can still supply the U.S. market without facing the full brunt of the import taxes. This strategic pivot underscores Japan's adaptability and determination to protect its economic interests. By relocating production, it minimizes the tariff's impact while maintaining access to American consumers, albeit through a more circuitous route. For the U.S., this could mean a reduction in domestic manufacturing jobs tied to Japanese brands, even as the tariffs were ostensibly designed to protect American workers. The irony is stark. A policy meant to bolster the U.S. economy may instead accelerate the offshoring of production, leaving American workers and consumers caught in the crossfire of this escalating trade dispute. As both nations dig in, the stage is set for a prolonged economic standoff, with the automotive sector serving as a critical battleground. Global financial shifts, a worldwide retreat from U.S. assets. The global financial landscape is undergoing a seismic transformation, driven by a wave of nations distancing themselves from U.S. economic dominance in late 2024. This shift, marked by a massive sell-off of American assets, reflects a growing unease among international players about the stability of U.S. financial instruments, even as the dollar retains its reputation as a bedrock currency. Countries across the globe, from emerging markets to established powers, have begun unloading billions in U.S. bonds and investments, signaling a potential reorientation of their economic strategies. What began as isolated moves has snowballed into a broader trend, raising critical questions about the future of America's role as the world's financial anchor. The numbers tell a striking story. In the final 3 months of 2024, Brazil led the charge by divesting $55 9 billion in U.S. assets, followed closely by Ireland, which shed $42 billion. Canada and the Cayman Islands weren't far behind, reducing their holdings by $37 billion and $41.02 billion, respectively. India and Norway each trimmed nearly $35 billion, while even traditional allies like Japan and China scaled back by $7.08 billion. This wasn't a mere market correction. It was a coordinated retreat by a diverse array of nations, each acting independently yet contributing to a collective signal of distrust. For decades, U.S. Treasury bonds have been viewed as a safe haven, a near-guaranteed store of value amid global uncertainty. Yet this exodus suggests that confidence is wavering. Even among countries with deep economic ties to the U.S., the stability of the dollar, once an unshakable pillar, no longer seems sufficient to outweigh the risks these nations perceive. Japan's role in this financial upheaval is particularly noteworthy. As the second-largest foreign creditor to the United States, holding over $1.01 trillion in Treasury bonds, Japan commands immense leverage. In February 2025, it made a decisive move by selling off $30 billion worth of these bonds, a transaction that reverberated through global markets. This wasn't just a symbolic gesture, it directly weakened the US dollar and pushed up interest rates in America, creating a cascade of financial pressure. For Japan, this action serves a dual purpose. It's both a defensive response to US tariffs on its automotive exports and an offensive play to assert its economic influence. By liquidating these assets, Japan is signaling its willingness to use its financial clout as a weapon, challenging the US at a time when trade tensions are already running high. The move carries risks. Selling bonds could destabilize Japan's own economy if the dollar's decline accelerates, but it underscores a calculated shift in strategy. What's driving this global pullback? For some, like Brazil and India, it may reflect a desire to diversify away from US-centric investments as they bolster their own regional economies. For others, like Canada and Japan, it's a reaction to U.S. policies, tariffs, political instability, or a perceived erosion of economic reliability that threaten their interests. The sell-off raises a provocative question. Are these nations preparing for a world where the U.S. is no longer the unchallenged financial superpower? If so, the implications are vast. A decline in demand for U.S. bonds could force America to raise interest rates further, increasing borrowing costs for its government and citizens alike. Meanwhile, the funds withdrawn are likely being redirected elsewhere, perhaps into emerging markets, alternative currencies, or even gold, reshaping global capital flows. As this trend unfolds, the U.S. faces the challenge of reassuring allies and investors that its economic foundation remains solid, a task made harder by each bond sold and each dollar weakened. Impact on U.S. consumers. A rising cost burden hits hard. The escalating trade disputes between the United States and its global partners are delivering a punishing blow to American consumers, particularly through the lens of the automotive market. At the center of this storm is a proposed 25% tariff on imported vehicles and parts, a policy that threatens to upend the affordability of cars, an essential lifeline for millions of U.S. households. Over the past year, more than 7 million imported vehicles rolled into the American market, a testament to the nation's heavy reliance on foreign manufacturers like Toyota, Honda, and Nissan. These cars, long prized for their quality and value, have become staples for the middle class. But with the looming tariff, the price of a typical car could surge by $5,000 to $10,000, transforming what was once an attainable purchase into a financial stretch for working families already grappling with post-pandemic economic pressures. The math is stark. Today's average new car price hovers around $49,000. A figure that's already steep for many buyers. With the tariff in place, experts predict that number could climb to $52,000 or even $53,000 within a year. This isn't just a minor inconvenience, it's a direct assault on the budgets of middle-income Americans who depend on vehicles for commuting, family needs, and economic survival. The timing couldn't be worse. After years of rising living costs, housing, groceries, healthcare, these families have little wiggle room left. A car price hike of this magnitude could force tough choices: delay buying a new vehicle, settle for a used model with its own rising costs, or take on more debt through financing, locking them into long-term financial strain. For a nation where car ownership is intertwined with personal freedom and economic opportunity, this shift feels like a betrayal of the American dream. The broader consequences are equally troubling. As new car prices soar, demand could plummet, prompting automakers to slash incentives like 0% financing or cash rebates that have historically softened the blow for buyers. Some manufacturers might even pause shipments of models tailored for the U.S. Further shrinking options on dealership lots. If fewer people buy new cars, the ripple effects could cascade through the economy. Dealerships lose sales, mechanics see less trade-in business, and consumer spending weakens overall. The used car market, often a fallback for budget-conscious buyers, isn't immune either. As demand shifts there, prices will creep up, squeezing affordability from both ends. This isn't just about cars, it's about the erosion of purchasing power for a middle class already stretched thin. The irony is palpable. A tariff meant to protect American jobs by punishing foreign imports may instead punish American wallets. Over 50% of car parts and vehicles sold domestically, even those labeled "made in the USA," come from abroad, including Japan, Canada, Mexico, and South Korea. Tariffs on these components drive up production costs, which get passed on to consumers regardless of where the car is assembled. Economists like Mark Zandi of Moody's Analytics warn that if this policy sticks, the fallout could extend beyond the auto industry, dragging down consumer confidence and slowing economic growth. For the average American, the message is clear. The cost of economic nationalism is coming out of their paychecks, one car payment at a time, with little relief in sight. Challenges of reshoring manufacturing. A tough road to made in America as trade tensions escalate and tariffs reshape the global auto industry. A familiar rallying cry has emerged in the United States: bring manufacturing back home. Manufacturing back home. The idea is seductive in its simplicity. Slap tariffs on foreign imports, incentivize companies to build cars on American soil, and watch jobs and prosperity return. It's a vision that taps into nostalgia for a time when a "made in the USA" was a badge of pride. But beneath the surface, the reality of reshoring automotive production is a tangled web of logistical, economic, and practical hurdles that defy quick fixes. Far from being a silver bullet, this endeavor reveals just how deeply integrated the U.S. economy is with global supply chains, and how hard it is to unwind that dependence. The timeline alone is a daunting obstacle. Building a new auto manufacturing plant from the ground up isn't a matter of months. It takes at least 2.5 to 3.5 years under the best conditions. This includes securing land, navigating regulatory approvals, constructing facilities, and installing the specialized equipment needed to churn out vehicles. For companies like Toyota or Honda, already reeling from U.S. tariffs on their imported parts, that's a long wait to regain competitiveness. And time isn't the only issue. Restructuring an entire production system means rethinking supply chains that span continents. Over 50% of parts in cars sold in America, whether assembled domestically or abroad, come from countries like Japan, Mexico, and Canada. Relocating those suppliers to the U.S. requires convincing dozens of companies to uproot their operations, a process that could take years and billions of dollars in investment. Cost is another towering barrier. The U.S. offers a skilled workforce and advanced infrastructure, but it comes with a price tag. Labor costs here are significantly higher than in Mexico or Southeast Asia, where Japanese automakers are increasingly shifting their production to dodge tariffs. Operating expenses, energy, taxes, compliance with stricter environmental standards also stack up, making it tough for manufacturers to produce cars at prices competitive with lower-cost imports. Even if a company builds a plant stateside, the parts ecosystem remains a challenge. is the training engineers to adapt to new processes, updating technologies to meet U.S. specifications, and ensuring a steady flow of domestic components add layers of expense and complexity. Without massive subsidies or long-term policy support, the math simply doesn't work for many firms. The result? Higher car prices for consumers, undermining the very goal of affordability that tariffs aim to protect. The bigger picture is sobering. Reshoring sounds patriotic, but it's not a plug-and-play solution. And decades of globalization have woven auto production into an intricate tapestry of international cooperation. Ripping it apart risks unraveling more than just trade balances. American automakers like Ford and GM already rely on foreign parts for their domestic vehicles. Forcing a rapid shift could disrupt their operations too. Meanwhile, foreign competitors might double down on production elsewhere, flooding the U.S. market with tariff-dodging cars assembled in Mexico or beyond. For all the political appeal of bringing manufacturing home, the practical truth is that it's a slow, costly slog, one that might leave the U.S. economy worse off before it gets better, with consumers and workers caught in the lurch. Market reactions. Investors brace for a rocky road ahead. The announcement of steep tariffs on imported vehicles and parts has sent a jolt through financial markets, with the auto industry bearing the brunt of the fallout. Investors, quick to gauge the implications of escalating trade tensions, wasted no time in reacting. In a single trading session following the tariff news, the stock prices of major U.S. automakers took a nosedive. General Motors saw its shares plummet by 5%, Ford dropped 3%, and Stellantis followed suit with a similar downward slide. These weren't just knee-jerk reactions or fleeting market hiccups. They signaled a deeper, more persistent unease about the future profitability of an industry already navigating choppy waters. For Wall Street, the message was clear. The costs of this trade war are piling up, and the pain is only beginning. The declines reflect a grim reality for automakers. So, tariffs, like the proposed 25% levy on foreign cars and components, inflate production expenses at a time when companies can ill afford it. For firms like GM and Ford, which rely heavily on parts from Japan, Mexico, and Canada, countries now caught in the tariff crosshairs, the math is unforgiving. Higher input costs shrink profit margins, especially as manufacturers face pressure to either absorb the hit or pass it on to consumers already balking at rising car prices. Meanwhile, foreign players like Toyota and Honda, stung by tariffs on their imports, are shifting production overseas, threatening U.S. market share and the jobs tied to their domestic operations. Investors see this as a double-edged sword. American companies lose competitiveness, while foreign ones adapt by sidestepping the U.S. entirely. The result is a sector squeezed from all sides, with little room to maneuver. Beyond the immediate stock drops, there's a palpable sense of long-term dread. Industry insiders and analysts are sounding the alarm, with one auto executive warning that these policies could tip the sector into a full-blown recession. The logic is straightforward. If car prices climb by $5,000 to $10,000 as predicted, demand could crater, leaving dealerships with unsold inventory and factories with idle lines. This isn't just an isolated risk, it's a contagion waiting to spread. The auto industry is a linchpin of the broader economy, supporting a vast supply chain of parts makers, steel producers, and logistics firms. A downturn here could ripple outward, dragging down related sectors and eroding investor confidence across the board. The 5% dip in GM stock isn't just a number, it's a barometer of fear that the damage won't stop at the factory gate. For markets, this is more than a short-term blip, it's a recalibration of expectations. The tariff gamble, pitched as a way to bolster American manufacturing, is instead spooking shareholders who see shrinking profits and a looming consumer backlash. As automakers brace for higher costs and lower sales, the market's verdict is in. Uncertainty reigns. Whether it's a temporary correction or the start of a steeper decline, one thing is certain: investors aren't betting on a smooth ride. They're buckling up for turbulence, watching closely as this trade experiment tests the resilience of an industry and an economy already on edge. Canada's response and Tesla's plight. A northern strike hits hard as the United States ramps up its tariff offensive. Canada has emerged as a fierce counterpuncher in this North American trade showdown, with Tesla caught squarely in the crosshairs. The U.S. decision to impose hefty tariffs on Canadian goods, part of a broader protectionist push, has sparked a swift and sharp response from Ottawa. Canada isn't just matching rhetoric with rhetoric. It's hitting back with a 25% tariff on $155 billion worth of U.S. exports, targeting everything from aluminum and steel to consumer products. But the real sting comes in its strategic assault on Tesla, the poster child of American electric vehicle, cool innovation. By slapping special tariffs on Tesla vehicles, axing subsidies for the company, and threatening to choke off exports of rare minerals like lithium, nickel, and cobalt, crucial for EV batteries, Canada is playing hardball. This isn't a random jab. It's a calculated move to wound a U.S. industrial titan while bolstering its own economic interests. For Tesla, the stakes are sky high. Canada has long been a key market, accounting for over 50% of EV sales there, thanks to its tech-savvy consumers and green energy push. But with these new tariffs, Tesla's prices could jump by $5,000 to $15,000 per vehicle, eroding its edge over rivals. The loss of subsidies, once a lifeline for affordability, compounds the problem, while the potential mineral export restrictions strike at the heart of Tesla's supply chain. These materials, abundant in Canada, are the lifeblood of EV battery production, not just for Tesla, but for Ford, GM, and others. If Canada tightens the tap, U.S. automakers could face soaring costs and production delays, threatening the entire American EV ecosystem. Ottawa's message is blunt. If the U.S. wants a trade war, it'll feel the pain where it hurts most, its cutting-edge industries. Canada's strategy goes beyond retaliation. It's a bid for self-reliance and regional clout. The country is pouring resources into its domestic EV sector, backing firms like Lion Electric and forging partnerships with GM and Ford to build a homegrown industry. By targeting Tesla, Canada clears space for its own brands to thrive, aiming to shift consumer loyalty northward. Provinces are piling on too. British Columbia is slapping tolls on U.S. trucks and banning liquor from Republican states, while Nova Scotia and Alberta tweak trade rules to squeeze American firms. Meanwhile, Canada is pivoting its exports toward Japan, Australia, and Europe via trade pacts like the CPTPP and CETA, reducing its dependence on the U.S. market. This isn't just defiance. It's a blueprint for a future less tethered to its southern neighbor. For Tesla, the fallout could be brutal. Losing ground in Canada might push it toward cheaper Chinese competitors like BYD, already eyeing the market. If the U.S. retaliates with more tariffs, the cycle could spiral, hammering both nations' auto sectors. Magna International, a Canadian parts giant, would feel the pinch too. This isn't just about one company. It's a test of whether Canada can flex its economic muscle and force a rethink of U.S. policy. For now, Tesla's plight is a glaring symbol of a trade war that's no longer just about goods. It's about power, pride, and the future of mobility. Social and economic fallout in the U.S. A nation unraveling the United States is facing a deepening crisis that transcends trade disputes, cutting to the core of its social fabric and economic vitality. Policies under the Trump administration, marked by tariffs, rights rollbacks, and political upheaval, are driving an unprecedented exodus of talent and trust, with ripple effects that threaten America's future. This isn't just about cars or bonds. It's about people, tech professionals, scientists, entrepreneurs, and families who are packing up and leaving for Canada, Germany, and Ireland in record numbers. Immigration firms report a flood of applications, with Ireland noting a 50% surge in American passport requests in a single year, and Germany's Max Planck Institute swamped by U.S. researchers. These aren't the downtrodden or desperate. They're the skilled, the educated, the very backbone of American innovation, fleeing a country they no longer see as safe or stable. What's pushing them out? For many, it's a cocktail of fear and disillusionment. The dismantling of protections for vulnerable groups, LGBT+ individuals, immigrants, minorities, has hit hard, especially for families with transgender children who now face discrimination without legal recourse. Gun violence, fueled by relaxed firearm laws, looms larger with mass shootings in schools and neighborhoods, making daily life a gamble. Political unrest and racial tensions add to the unease, painting a picture of a nation fraying at the seams. Professionals, meanwhile, see better prospects abroad: Canada's tech hubs, Germany's research institutes, Ireland's tax incentives, where their skills are welcomed without the baggage of instability. This brain drain isn't idle chatter, it's action, a quiet rebellion against a homeland that feels increasingly unrecognizable. Economically, the fallout is dire. Losing these high earners guts critical sectors: tech, healthcare, science, leaving gaps no policy can quickly fill. As young workers exit, the labor force shrinks while an aging population grows, straining Social Security and pensions with fewer contributors. Consumer spending, a driver of U.S. growth, is tanking as affluent families take their dollars elsewhere, spooking investors and businesses alike. The numbers are stark. A drop in demand could spark job cuts, slashed investments, and a vicious cycle of stagnation. If this trend holds, the U.S. risks losing its edge as the world's top economy, ceding ground to nations capitalizing on its talent hemorrhage. Canada and Germany aren't just destinations, they're competitors, luring the best and brightest with promises of safety and opportunity. For those left behind, the social cost is palpable. Communities lose cohesion as neighbors depart, schools lose teachers, and cities lose vibrancy. The middle class, already battered by rising costs, watches car ownership, a symbol of independence, slip further out of reach as prices climb. This isn't just a policy misstep, it's a slow bleed of confidence in the American promise. If the U.S. can't stem this tide, it faces a reckoning, not just of its economy, but of its identity as a land of possibility. The question looms: can it rebuild trust before the damage is irreversible? Constitutional crisis risk. Democracy on the brink. A chilling development has thrust the United States into uncharted territory, raising the specter of a constitutional crisis that could unravel the foundations of its democracy. At the heart of this storm is an unprecedented executive order signed by Donald Trump, granting the president, or his handpicked attorney general, sole authority to define U.S. law. This isn't a casual overreach or a fleeting tweet storm. It's a deliberate power grab that sidelines independent agencies like the Federal Election Commission, the Securities and Exchange Commission, and the Environmental Protection Agency, (C). With a single stroke, these bodies, designed to check executive excess and uphold impartial governance, could be rendered toothless, their mandates rewritten at the whim of one man. What was once a dystopian hypothetical now feels perilously close to reality, surreality, shaking the bedrock of American checks and balances. The implications are staggering. By centralizing legal interpretation in the executive branch, this order dismantles the separation of powers that has defined U.S. governance for over 2 centuries. Congress, tasked with crafting laws, and the Supreme Court, charged with interpreting them, could be bypassed entirely. Imagine a scenario where the president dislikes a judicial ruling. He could simply veto it, no appeal, no recourse. Agencies that regulate everything from elections to environmental standards would answer only to Trump or his loyalists, turning impartial oversight into a tool of political will. This isn't just about control, it's about rewriting the rules of democracy itself. If the courts lose their role as the final arbiter, the Constitution, already strained by polarization, becomes little more than a suggestion, subject to the president's mood or agenda. The threat goes beyond legal theory. It's a practical assault on democratic norms. Critics see this as Trump placing himself above the law, a move echoing authoritarian playbooks where power consolidates unchecked. If he can nullify regulations or silence dissent by fiat, the guardrails of accountability vanish. Vulnerable communities, already reeling from rights rollbacks, could face further erosion of protections with no independent refuge to turn to. Businesses, too, might chafe under arbitrary edicts, destabilizing markets already jittery from trade wars. And yet the order's audacity lies in its simplicity. By claiming to streamline governance, it cloaks a radical shift in a veneer of efficiency, daring opponents to prove it's illegal after the fact. The stakes demand a response. History shows that silence in the face of such overreach breeds tyranny. Every dictatorship begins with a step like this: met with apathy or fear. Pressure on lawmakers, especially Republicans who hold sway in Congress, is crucial. They weren't elected to serve one leader but to defend a system. Citizens, too, must act. Calls, protests, votes, because inaction is complicity. This isn't just about Trump's next move. It's about whether America has the resolve to protect its democracy. The clock is ticking, and the line between liberty and autocracy grows thinner by the day.